Dear friends, I want to begin by saying this. We're at a point in our financial ecosystem where things are shifting beneath our feet. You've heard the headline, Silver price explodes higher $50, silver won't last long. And indeed, what seems like a bold statement is actually the logical outcome of forces many are failing to account for. My purpose today is to walk you through the reasoning, the risks, and the opportunities not with hype, but with clarity. When trying to understand what is happening with silver right now, it's essential to step back and see the full macro cycle, not just the daily price fluctuations. Everything in markets moves in long-term patterns driven by the interaction between debt, productivity, money creation, interest rates, and human behavior. These forces are interconnected, and when one shifts, the ripple effects appear across the entire financial system. What's unfolding in silver is part of a much larger process, one we've seen repeated throughout history, just in different forms. The fundamental truth is that economies move in cycles. They expand, they contract, they inflate, they deflate. Policymakers push interest rates up or down, debt grows, then becomes overwhelming. Currency weakens, then strengthens. These cycles overlap and influence each other, and metals like silver tend to react most dramatically when a cycle is reaching an inflection point. That's what we're witnessing. Inflation pressures aren't isolated. They're the natural outcome of a period of excessive monetary expansion layered onto a world still adjusting to structural supply disruptions. Eventually, the imbalance manifests in higher prices for anything tied to real value, including precious metals. In many ways, silver is signaling that the monetary environment is shifting. When interest rates stay artificially low for too long, debt accumulates to levels that can't be serviced without further stimulus. When central banks try to tighten, the financial system starts to strain. The market senses vulnerability and looks for safe stores of value. Historically, people turn to assets that cannot be printed, expanded at will, or diluted by policy decisions. Silver fits into that narrative, sitting at the crossroads between being a monetary hedge and an industrial necessity. When these two roles collide in a tightening economic environment, demand becomes asymmetric and prices begin to accelerate. Another piece of the macro cycle is the behavior of currency. As a currency weakens, whether through inflation, policy missteps, or loss of investor confidence, real assets strengthen. People often see silver rising in price and think the metal is becoming more valuable. In truth, it may simply be reflecting the decreasing purchasing power of the currency it's priced in. This is why understanding cycles is important. What appears as strength in one direction may simply be weakness in another. Silver's movement is not only about supply and demand, it's about the context in which supply and demand exist. History teaches us that when governments and central banks face large debt burdens, they have limited choices. They tighten policy, causing contractions, or they let inflation erode the value of the debt. Rarely do they allow defaults on a broad scale. The most politically acceptable path is to inflate the debt away. That means more money creation, more liquidity, and ultimately more pressure on real assets to reprice. Silver sits in the position of being sensitive to these pressures because it is both scarce and essential. Unlike fiat currency, you cannot produce it with the click of a keyboard. Unlike many commodities, it has both monetary and industrial utility. These characteristics become increasingly important when cycles shift from expansion to pressure. What we're seeing now is the early phase of recognition. Markets don't move all at once. They move in stages. First, the informed minority sees what's happening, then the broader investor community begins to shift. Eventually, the public follows. By the time everyone agrees on a narrative, the biggest moves have already taken place. The current rise in silver isn't just a reaction to short-term events. It's the front edge of a cycle transition from one monetary environment to another. This is why the movement feels sharp, why the narrative feels urgent, and why the implications extend far beyond a single price level. We're also in a period where geopolitical tensions, supply chain realignments, and energy transitions are impacting the macro cycle at the same time. These aren't isolated issues. Together they create a feedback loop. High energy prices feed inflation. Inflation forces central banks into action. Their actions stress economies already carrying heavy debt loads. Stress leads to volatility. Volatility leads investors toward real assets. Each layer reinforces the next. So when looking at silver today, don't focus solely on whether it reaches $50 or retreats to $30. Focus on the cycle. Focus on the forces behind the movement. Focus on the patterns that have repeated for centuries. The price of silver is a symptom, not the root cause. The cause is the shift happening beneath the surface, the end of one phase and the beginning of another. Those who understand the macro cycle won't be surprised by what comes next. They will be prepared. The most important advantage anyone can develop in markets is the ability to see what others are missing. Not because you're smarter, but because you're willing to be radically open-minded. Most people operate with fixed assumptions, emotional reactions, and confirmation bias. They see what they want to see, not what is actually unfolding. They chase headlines, follow momentum, and repeat the same narratives without examining whether the underlying conditions still justify those beliefs. To truly understand what the market isn't seeing, you have to question everything, including your own conclusions. The market tends to be reactive rather than anticipatory. When silver moves sharply higher, most people assume it's simply speculative momentum. They look at the surface level cause a report, a geopolitical event, a supply disruption, and decide that's the full explanation. But the real drivers are deeper. What most participants overlook is the underlying structural story. They underestimate the fragility of the monetary system, the accumulation of debt, the diminishing confidence in currencies, and the behavioral tendencies of crowds when pressure rises. The market often misses the early signals because it's conditioned to respond only when events become undeniable. Being open-minded means recognizing that what seems unlikely may actually be inevitable. Silver breaking above traditional resistance levels isn't shocking if you understand the environment. Yet, many dismiss the move as temporary because they're anchored to past price ranges. They assume the future must behave like the past without appreciating that cycles shift and new conditions require new expectations. This anchoring blinds them to possibilities that lie just beyond their current belief system. To see what the market isn't seeing, you have to abandon the illusion of certainty. Don't try to predict. Instead, build probabilities. Don't fall in love with one outcome. Prepare for many. Test your assumptions ruthlessly. Ask yourself, what if I'm wrong? What if the opposite occurs? What if the environment has changed more dramatically than I realize? When you question your own thinking, you uncover the blind spots that others ignore. And those blind spots often contain the biggest opportunities. Most investors rely heavily on consensus opinions. They listen to analysts, read reports, and follow sentiment indicators. But consensus is almost always backward looking. It reflects what everyone has already processed, not what is coming. By the time the majority recognizes a shift, the easy money has already been made. You cannot rely on the crowd to guide you through uncertain times. You have to be willing to step outside the comfort zone and analyze reality as it is, not as you wish it to be. That requires humility and a willingness to let go of old narratives. Silver's current trajectory offers a perfect example. The market focuses on short-term supply dynamics, mine output, recycling flows, industrial demand fluctuations. While these matter, they don't tell the full story. What the market often fails to see is how quickly sentiment can shift when the underlying macro environment changes. Once investors realize that inflation is not transitory, that currency debasement is accelerating, that geopolitical tensions are intensifying, and that debt burdens are rising to unsustainable levels, the move toward real assets becomes a stampede. The shift happens slowly, then suddenly. Open-mindedness also means recognizing that the relationship between assets is not static. Silver is not just a commodity, it is a hedge, a store of value, a strategic resource, and a psychological anchor. When uncertainty rises, its role expands. The market may see silver as undervalued because it is looking at it through a narrow lens. But when the lens widens, when people recognize silver's broader position in a changing global landscape, the valuation paradigm shifts. What once seemed expensive suddenly becomes cheap relative to the systemic risks surrounding it. To uncover what the market isn't seeing, you must look where others aren't looking, study the extremes. Analyze the outliers, pay attention to behaviors that deviate from the norm. Look for contradictions in the data. Markets often whisper before they speak loudly. Silver's recent surge wasn't random. It was preceded by months of subtle signals: tightening supply, rising industrial demand, broader financial stress, weakening currencies, shifting investor psychology. Those who listened early saw what others ignored. The key is to stay mentally flexible. Don't lock yourself into a single narrative. Let the data guide you. When new information challenges your view, don't defend your old position, update it. This is how you avoid being blindsided. The market punishes rigidity and rewards adaptability. Those who cling to outdated beliefs find themselves reacting late to changes that were visible for anyone willing to look with fresh eyes. At the heart of being radically open-minded is the willingness to embrace uncertainty. Instead of fearing it, understand it. Uncertainty is not the enemy, it's the environment in which opportunity thrives. When you accept that you don't know everything, you open the door to deeper insights. You stop trying to force the market into your expectations and start seeing it as it truly is. That shift alone can separate you from the crowd. In times of transition like the one unfolding now, the market's blind spots grow larger, not smaller. People cling to familiar reference points even as the ground beneath them shifts. Your job is to observe, question, and adapt. When you do, you position yourself not only to survive the change but to benefit from it. That's the advantage of radical open-mindedness. It gives you clarity in moments when others are lost in noise. When the environment shifts as dramatically as it's shifting now, the most important responsibility is to manage risk intelligently. The consequences of ignoring risk are always far greater than the cost of preparing for it. Most people get caught off guard because they're either too confident or too emotional. They underestimate how quickly conditions can change and how fast markets can reverse. That's why preparation isn't optional, it's essential. You don't control what happens, you control how ready you are for whatever happens. The first step is to recognize that risk comes in layers, There's market risk, liquidity risk, psychological risk, and even opportunity risk. Most focus only on price volatility, the visible type of risk, while forgetting that the most serious dangers are often invisible. Silver rising to $50 and beyond is exciting on the surface, but beneath that excitement lies uncertainty. If you're not prepared, volatility can shake you out at the worst possible moment. Proper positioning means knowing how much you can allocate without emotional disruption. If your exposure causes you to panic when prices dip, you haven't sized your risk correctly. Preparation starts with clarity. You need to understand why you are positioned the way you are, what you expect, and how you will respond to different outcomes. If you can't articulate your reasoning, you're likely reacting, not preparing. Markets punish reactive behavior. They reward disciplined thinking. You don't need to predict the future. You need to build a plan resilient enough to survive multiple futures. That's the essence of managing risk, being structurally prepared rather than emotionally hopeful. One of the biggest risks in moments like these is crowd behavior. When silver starts rising sharply, the herd rushes in. They chase prices and ignore fundamentals. When the inevitable pullback comes, even if temporary fear sets in, the same people who rushed in blindly now rush out equally blindly. This creates wild swings that have little to do with intrinsic value and everything to do with psychology. If you want to avoid being tossed around by crowd emotion, you have to detach from it. Make decisions based on logic, not noise. To prepare effectively, you must also acknowledge that cycles always move in waves. There are expansions and contractions. There are impulsive rallies and corrective periods. Silver may surge rapidly, but that doesn't mean the path will be straight. There will be periods of consolidation, shakeouts, corrections, and reassessments. If you expect a smooth path, you'll be disappointed. If you anticipate volatility, you'll be empowered. Preparation is not about predicting exact turns. It's about maintaining your composure through them. Diversification remains a crucial part of risk management. That doesn't mean owning everything randomly. It means structuring your portfolio so that no single outcome can damage you too heavily. You don't want to be all in on one scenario or fully exposed to one possibility. The smartest positioning balances conviction with prudence. You allocate meaningfully, but not recklessly. You position boldly, but not irrationally. If silver does rise significantly, you benefit. If volatility takes over or conditions shift unexpectedly, you're not crippled. Another element of preparation is maintaining liquidity. Many overlook this. Liquidity gives you optionality, the ability to act when opportunities appear. When markets panic, liquidity dries up quickly. Those who are overleveraged or fully allocated get trapped. They cannot take advantage of opportunities because every decision becomes reactive. By maintaining some dry powder, you can act strategically rather than emotionally. Liquidity is not wasted capital, it's strategic capital. Risk management also requires constant recalibration. The environment shifts, and your views must shift with it. If inflation accelerates, adjust. If central banks pivot, adjust. If geopolitical stress escalates, adjust. Being anchored to an outdated position is one of the most damaging behaviors in investing. Flexibility is not weakness, it's strength. The strongest systems survive because they adapt. The weakest collapse because they resist change. A major risk in environments like these is overconfidence. When silver moves higher and the narrative strengthens, it's easy to believe the move will continue indefinitely. That's when mistakes happen. When sentiment is euphoric, discipline often disappears. You must remain grounded. Understand that markets can overshoot both to the upside and the downside. Don't let short short-term excitement blind you to long-term realities. You have to protect yourself from your own optimism as much as from the market itself. Ultimately, the goal is not merely to benefit from an upward move. It is to ensure you remain intact through all phases of the cycle. Wealth is built over time by avoiding major mistakes, not by chasing every explosive opportunity. Preparation is your defense against disruption. Risk management is your foundation. Together, they give you the stability to navigate uncertainty with confidence. When you prepare thoughtfully, you don't fear volatility, you use it. In the end, preparation is not about expecting disaster. It's about respecting the complexity of the environment and positioning yourself in a way that allows you to survive, adapt, and eventually thrive. Those who manage risk intelligently endure. Those who ignore it eventually learn the hard way. The choice is simple: prepare now or pay later. One of the most important disciplines in navigating shifting markets is the ability to act decisively when the facts change. Most people cling to their old beliefs. They stay anchored to past assumptions, familiar narratives, and outdated expectations even as the environment transforms right in front of them. This attachment makes them slow to respond, and in markets, being slow is often as costly as being wrong. The real edge comes from recognizing when reality has changed and adjusting before everyone else sees it. The world is not static. Conditions evolve, new information emerges, policies shift, sentiment swings. Markets move. What was true 6 months ago may not be true now. What seemed impossible last year may become the new baseline. If you insist on holding onto old conclusions when the facts have changed, you're not thinking, you're reacting. Acting decisively doesn't mean being impulsive. It means aligning your actions with updated realities rather than outdated assumptions. The biggest challenge for most people is psychological. Once they commit to a view, whether bullish or bearish, they unconsciously look for evidence that validates it and ignore evidence that contradicts it. They become attached to being right. They defend their position long after the data has shifted. This rigidity is the silent destroyer of portfolios. The market punishes stubbornness because stubbornness is the refusal to adapt. To act decisively, you must detach your ego from your decisions. Being wrong is not a failure. Refusing to adjust is. The environment is constantly offering signals. It tells you when risks are rising, when momentum is shifting, when sentiment is turning, when liquidity is tightening, and when supply and demand are realigning. If you're open enough to observe those signals objectively, you can position yourself ahead of the crowd. If you cling to what you want to be true, you'll be blindsided when the market forces its truth upon you. Silver's recent movement is a perfect example. For years, many dismissed the possibility of a structural breakout. They believed the same old ranges would hold because they always had. They assumed inflation would remain low, monetary policy would stay stable, and geopolitical risks would remain manageable, but the facts changed, inflation surged, debt exploded, interest rates became volatile. Supply chains strained, investor confidence weakened, the system shifted and silver responded. Those who paid attention adjusted early. Those who clung to old narratives were forced to adjust late. Acting decisively when the facts change means accepting discomfort. You may have to exit positions you've held for a long time. You may have to abandon narratives you've been emotionally attached to. You may have to reconsider assumptions that once felt unshakable. Growth requires letting go. Progress requires movement. If you resist the change, you become trapped by it. A critical part of decisive action is having a clear process. You need criteria that tell you when your assumptions no longer hold. You need signals in data, in behavior, in sentiment, in policy that trigger adjustments. When the facts violate your thesis, you act. When the environment shifts in a meaningful way, you reposition. Without a process, you fall back into emotional decision making, and emotional decisions are rarely strategic. Timing also matters. Acting decisively doesn't always mean acting immediately. It means acting at the right moment. Often there is a window not too early, not too late where the odds are most favorable. If you're early, you might endure unnecessary pain. If you're late, you lose the advantage. Decisiveness is about sensing that window and taking action in alignment with it. That's why awareness and patience must work together. Another important point, decisiveness is symmetrical. It applies when conditions improve and when they deteriorate. It applies when opportunities arise and when risks intensify. Acting decisively doesn't only mean buying when the facts support buying. It also means selling when the facts support selling. Many people hesitate to take profits because they're afraid of missing additional upside. Others hesitate to cut losses because they're hoping for a reversal. Both are forms of indecision driven by fear. True decisiveness is not emotional, it's logical. The ability to act decisively is built over time. It requires practice continuously updating your views, reassessing your assumptions, staying open to new information, and resisting the temptation to settle into complacency. It is uncomfortable but deeply effective. You become more aligned with reality and less tied to narrative. You become more fluid, more responsive, and ultimately more resilient. When the facts change, it's an invitation to evolve. Markets reward those who adapt and punish those who resist. The environment doesn't wait for anyone to catch up. It simply moves. Your job is to move with it. The faster you accept that change is constant, the easier it becomes to navigate it. In a world of rapid shifts, decisive action grounded in updated information is a powerful advantage. And when you act decisively, not blindly, not emotionally, but intelligently, you position yourself to capture opportunity and avoid disaster. That's how you endure. That's how you grow. That's how you stay ahead. So where does that leave us? If I were to summarize, we are entering a phase where silver is not just a commodity. It is a barometer of deeper systemic change. The price at which silver trades, whether it goes to $1.50, beyond it, or retreats, will tell us something about currencies, debt, inflation, and real value. My view is this: $1.50 is likely not the end. It may well be the beginning of a phase where traditional assumptions are questioned, and those who prepared will benefit most. I encourage you, don't let the window pass you by. Examine your assumptions. Understand the system, manage your risks, and when the facts align, act with clarity and speed. Thank you for your attention. Let's remain vigilant, open-minded, and disciplined because the world is changing, and so are the rules.